little background about me. I'm 28. I was born and raised here in Phoenix, Arizona. So I've lived here most of my life. Out of high school, I had a full scholarship to a small Division II school in Colorado. So I was there for a bit, and I wanted to be like an NFL player. And I realized I wasn't big enough or good enough to make it to the NFL. So I came back to Phoenix, and I decided, okay, well, I want to be a sports journalist then. So I went to journalism school. I went to a really good journalism school, the Walter Cronkite School at Arizona State here, ASU, and I got my degree in journalism and broadcasting. And so I was a live news anchor on Arizona PBS for about 5-6 months, and I hosted a show on Fox Sports Network Arizona, and I was doing news packages and everything like that, which was really cool at first. But I quickly realized, just having a bunch of friends who were getting into the industry and doing those jobs, is that you just work crazy hours. You don't make a whole lot of money like you would think, and it's very political. So I was 21. I had just graduated, and I was like, man, I don't want to do this, and I had all this school debt. I come from like a lower middle class family, so never were affluent or wealthy or anything, but we always had what we needed. We were in good shape, but I had taken out school loans, and I was like, well, I have all this student debt, and I need to make money, and I need to pay off this debt. And so while I was going to school, my junior and senior year at ASU, I was delivering medical equipment like nights and weekends, like 40 hours a week to help pay for school out of pocket. And when I graduated, my boss at the time was like, hey, you can make pretty good money doing healthcare marketing. Okay. And so I was like, okay, well, I got this fancy degree. I have a lot of student debt. I don't want to do it. I'll go into healthcare marketing. And so of all things, I actually got a job as a hospice marketer. So I don't know how familiar with hospice care you are, Hayden and Dustin, but basically it's like mobile nursing and caregiving for people who have end-of-life illnesses. So they go to the homes, assisted livings, etc. My job was to wake up in the morning and drive all around Phoenix and just walk in cold to like hospitals, doctors' offices, assisted living, etc., and build relationships with physicians, nurses, social workers. And when they had somebody need these services, they call me. I'm the first person to go meet with that patient and family and educate them on the resources, and if they'd like, get them signed up, which is something that Medicare pays for 100%. So it's free for the patient and the family. So it sounds really weird, but hospice care is actually an extremely competitive and lucrative private business industry. And this Phoenix, Arizona market is like the #1 market in the country. And second is Florida. So it's kind of like the cliches you would think, right? It's very sunny, a lot of seniors. So anyways, long story short, I got this journalism degree. I was 21 and I started going into hospice marketing. I didn't know what I was doing or why I was even there, but I just knew I needed to make money and pay off debt. And so I was very fortunate to do well there. And within a year, I was making 6 figures. Okay. And by the time I was 23, I was making more money than both my parents combined, making like 160K a year. I bought a house when I was 23. And then I got my MBA. I was going to night school, got my MBA. And so over a course of 4 years doing the hospice, I started out as a marketer. I became the director of marketing. I was making 200K plus a year. And then I became a partner in the company. And so I was very blessed at a young age to be able to pay off all my student debt, get my MBA, pay cash. I had a house. I had a little over 100K of cash just in my checking account. And so I was really just knocking out all these goals. But I just started to get to the point where I just felt burnt out, and I didn't feel fulfilled. And I just felt like I was always chasing the next commission, you know what I mean? And you're only as good as your last month. I was working at least 50, 60 hours a week, on call 7 days a week. And so I had tried to pursue what I thought was my passion with the journalism, and I realized I didn't like it. And so I tried to pursue the money, which was fortunate for me to be able to become more financially established at an early age by making good money, but I still was not fulfilled, okay? So I knew I wanted to leave this company, but I didn't know what I wanted to do. And I was like 25, 26 at the time. And then the company I found out was going to be selling, okay? And I was like, I don't want to be a part of that. And I didn't want to do this anyway. I didn't know what I wanted to do, but I knew I didn't want to do that. So I was actually at a family Christmas party, and I met this guy who owned mobile home parks here in the Phoenix area. And he was just kind of telling me about it, and I was just fascinated because I had gotten my real estate license 2 years prior to leaving the hospice gig, but I had never known anything about real estate. So anyways, he tells me about this. He tells me about a book called Rich Dad, Poor Dad. So as the cliche story goes, right, everybody has that story. I read the book, kind of changed my mindset. And the next month, January, that was December of 17, the Christmas party. And I knew I didn't want to do it anymore, but I was too scared. Like I had golden handcuffs, right? Making 200K plus a year, getting a fat check. January of 2018, then the next month, I said, screw it. I resigned and I sold my equity in the company, and I had no plan. I didn't know what I wanted to do. I just knew that I wanted to somehow create passive income and gain control back over my time, right? And so I resigned, sold my equity. I made a couple hundred K from selling that equity, so it wasn't anything like huge, but I was still blessed to be in a good position. And I was dating my now fiance Grace at the time. So keep in mind, we didn't have any kids or anything like that. We're getting married later this year. We plan to have several, but at the time and now we don't have kids. So I was in a fortunate financial situation where I said, okay, I'm going to live off savings for the next 12 months. I'm just going to figure out how to create passive income through real estate. And I was initially thinking mobile home parks. I didn't know anything about multifamily, nothing about apartments. And keep in mind, I didn't know anybody in real estate except for this random guy I met at this Christmas party who owns some mobile home parks. I don't have any family who's been in real estate. I don't have like a rich uncle or anything like that. So anyways, I read the book. I started absorbing as many podcasts, book as I can, just like what you guys are doing here, Dustin and Hayden, and trying to listen to other people, try to learn from them. And I was looking at mobile home parks. So I cold called like over 90 mobile home park owners in the Phoenix metro area, trying to see if anybody of them would want to sell. Cause I had like 250, 260K of cash, and I didn't know what to do with it. And so I call these guys, like 5 or 6 of them answered. Most of them said no. I tried to buy one on a seller carry. It didn't work out. So I'm calling, and 3 months go by, and I'm just like, man, this is not working. And I started to learn about multifamily and syndication. Okay. And that really sparked my interest because I quickly realized that I'm so limited in the size of property I can buy with my 200K. You know, I can't really go too far, but I learned about syndication and having other people invest in the deal. So I had a network of physicians and healthcare business owners from being in the hospice arena. And a lot of these people also hated their lives like I used to because they have no time, right? But they make good money. And so I was like, that could be appealing. Maybe they're interested in investing. So that's when I decided right then and there that I wanted to do multifamily syndication. This was like March or April. So 3 or 4 months have gone by, like a good 100 days making no money, trying to figure out what to do. And I realized, okay, I want to do multifamily syndication because it's a more attractive asset class. And I think it's easier to sell to investors and talk to them about. So anyways, I decided to do that. And then I just started really focusing on that. I think some of the people watching this may be able to relate. Like when you're trying to get into this, it's easy to get distracted in different asset classes, different markets, different criteria. And you really do need to try to stay focused so that you can dive deep into that. So for me, that's when I realized multifamily is it. So I started reading all these books. Like I read Ken McElroy's ABCs of real estate investing, and then his property management book. And I read some other books. And I got to the point where I was like, okay, I've listened to all these podcasts. I've read all these books. I need to actually get out there and start meeting people. And so what I did is I started calling up property management companies, and I made a list of like 5 pages of questions, vetting all their operational, accounting processes, all these things. And then I would meet with these property management companies, and I would say, hey, can you refer me to a lender in the market who you like? And then I'd meet the lender, and then I would ask them, can you refer me to some brokers? So that was the big pivotal point for me, was just getting the courage to kind of meet with all these real estate professionals, because I was terrified, you know, and I was more of an outgoing sales marketing kind of guy, but I felt like I didn't belong in this industry because it's very intimidating, right? The numbers are big, the buildings are big. And so anyways, long story short, and you guys can interrupt me at any point and ask any questions, but long story short, I dive into that. 10 months go by. Okay. So 10 months have now gone by since I quit my job, and I've been focused on a multifamily for like a good 6 months. I burned through so much cash. I've made no money. I wake up every morning like, what do I do today to even progress on this? None of the deals are penciling. Very discouraging. I lost all my confidence, you know what I mean? Like my self-identity, because I was like, I used to be like the successful healthcare guy, and now you go to like a conference or something, you tell them you're a real estate investor, but you don't have any real estate and you haven't made any money. So it's just very discouraging. Long story short, 10 months go by. We finally get our first deal under contract. It was a 36 unit deal. I put almost all the money I had into the deal. We closed on that in February of 19. And while we were under contract, I knew I was going to be out of liquidity. So I sold my house, and a week after I sold my house, which was in April, I wired 100K non-refundable into a portfolio of 2 deals we had under contract. It was a 59 unit and a 76 unit. We were to close that. And then right after that, we got a 137 unit. And long story short, it took 10 months to basically get the first deal under contract, 13, 14 months to get it closed. But after that, we caught momentum, and we've acquired 5 assets, 420 units, 48 million in about 12 or 13 months after closing on the first deal. So it just kind of goes to show you can really catch momentum once you get the experience and get the first deal. But anyway, I know I talked a lot. Let me know if you guys have any questions or anything. Or dive into certain topics.
Awesome. Yeah. Is there anything that you would recommend? It sounds like focus and kind of burning the bridges was the 2 main things that you did to get started. So is that what you would recommend to somebody just getting started right now?
Yeah, good. That's a really good question, Hayden. I would not recommend that. I mean, you don't necessarily have to do that. I mean, obviously it sounds dramatic. Like I quit my job and went into it, and it sounds kind of cool when you're doing social media marketing, but it's not absolutely necessary. And the reality is, like I said, I was young and without kids, and I was in a fortunate financial situation to be able to live off of savings. But I don't think you have to do that. I think that you can absolutely have a full-time job and you can get into multifamily, but you need to take advantage of all your free time, you know? And so it just comes down to habits and consistency and cutting out stuff that doesn't matter, like cut out Netflix, cut out unnecessary social media time, things like that. I think those are very important so that you can try to move the needle forward each day and really squeeze that free time out to progress forward.
You've made a ton of progress in, relatively short amount of time. What are your goals for the next 5 years?
Yeah. Good question, Dustin. So basically my 2 partners are primary partners are Robert Shefchick and Bikram Sandhu. Robert's here local in Phoenix, Scottsdale area, like I am, and Bikram is in Orange County, California. He'll be moving to Phoenix soon. And so we formed this company, Summit Equity. And right now we're just really focused on this Phoenix metro market because we're local here and we have the broker relationships and we know the market. In the next 5 years, we plan to have at least 5,000 units and at least 500 million of assets under management. And so we want to be, which sound ambitious, but we know that if we focus and maybe we align with larger institutional groups, then that could be possible. And so we really just want to stay focused and continue to do a good job. But at the same time, you can't be too aggressive just because you have to be really careful. And this whole COVID-19 thing is a good example of that, right? I mean, everybody says they underwrite conservatively, but I think this will be a good test to see what deals do well and what true conservative underwriting is.
I think Emily had a good question to kind of follow that up. She asked, can you talk about the dynamics between the team of sponsors and what the different roles are with your partners?
Yeah, that's a great question, Emily. And that's really important because when I first started out, I was trying to do everything on my own, right? And it's very overwhelming. And you may be like a very well-rounded, smart person, but the fact is you cannot efficiently do all the roles that are required for the multifamily. So for example, like I got my MBA and I've taken like accounting classes and I've taken high-level economic classes and I understand it, but I freaking hate sitting in front of spreadsheets for hours at a time. You know what I mean? It drives me crazy. And that's what I was doing on the front end, trying to underwrite these deals. It just wasn't efficient. And so when I really found the partners that had complementary skill sets, that's when we feel like we've been able to now just finally after this last deal really catch our stride. And now we feel like we have a good system in place. And so to better answer your question, you need to have complementary skill sets. And when you're trying to find a partner with multifamily, it's kind of a cliche saying, but it's true. It's like dating, right? Like you need to try to find other people and try to quote unquote date them, meaning you want to find people who are ambitious and hungry like you are and who have a strong work ethic. Because the thing is with social media posts and stuff, like everything looks glamorous, but it really is a grind. And you're not going to make very much money for a while on these deals. You know, that's just the reality of it. And so you have to really have like a long-term mindset. You need to find people who are hungry like you are. And it's tough. It's like the chicken and the egg when you're starting out, because I mean, you have to have experience sometimes to do the deals, but you can't have experience, right? Because the brokers don't listen to you, or you don't have the net worth liquidity. So you really got to try to find those things. So for me, a big step was meeting Robert, one of my partners here, who's local, because I went over 6 months just cold calling people, trying to meet with people, and I could not find people who were serious, right? And I joined a mentorship program. That's where I met Dustin, actually. And I mean, you drop like $30K to enter a mentorship program. And it's a high barrier to entry, you know, so people who are in that are serious, and you can find different people. But even in that, I joined this mentorship program. I went through at least 6 or 7 different partners, quote unquote, where you say, okay, let's work together, and you start underwriting deals and making offers. And I quickly realized some people weren't as interested in the market. Some people weren't for real as far as being committed. Some people were very experienced at hundreds or thousands of units, but I felt like I was being taken advantage of because I was doing all the work, right? And they just want to kind of lend their experience, or I'll lend my balance sheet, which is great. You need that, but you also need to have at least one primary partner who's like your go-to person, who you can talk to and be real with, and who's available if you call them. And so it needs to be like a balanced partnership. So anyways, I went through a bunch of different people. I met Robert, who's here local, and he has high net worth, high liquidity, you know what I mean? Which was a good compliment because I don't have that. And so that allowed us to sign on that first loan. And then we just kind of find people who can serve different roles, who have experience. And ultimately we found Bikram, who's our other primary partner. And Bikram has an economics degree. He's a CPA, he's a corporate auditor. So he's a true numbers guy, right? But his passion is not talking to people. He'd rather just be behind a spreadsheet. So it's a perfect complementary partnership where you have, now we were kind of all doing everything. Now I am primarily focused on acquisitions and like business development. So cultivating relationships with new investors and meeting brokers. So from the acquisition phase, I'm the point person for communication with the broker, with our property manager, with the lender, with our SEC attorney, our transactional attorney, the lender's counsel, kind of coordinating, project managing all that communication, finding deals. Robert he has an architecture degree, a master's in architecture. He's also local here, and he's full-time real estate. And so he's primarily asset management. Okay. So he's post-acquisition is his primary focus. All right. So I'm primarily acquisition. Robert's primarily post-acquisition, meaning he's really doing day-to-day driving around, and we both drive around and check in, but he's constantly on our property managers, making sure the property's performing. Bikram is kind of like a hybrid because Bikram has the finance background and really enjoys the numbers, and he's gifted with the numbers. And so he's heavily involved with me on the front end as far as underwriting and modeling and working with the loan. And then also post-acquisition, watching the general ledger and watching financials. So we all have slight roles in every single department, and we're all on all the property management phone calls each week, but it's good to kind of identify what's your true strength and passion and make that your primary role, and then find complementary people. Because I had people that I got along with really well, and they were really hardworking, good people, but we quickly realized, like there's this one guy, myself, we realized we have the same skill set, right? It's building the relationships, but we're not as strong, or we don't want to put the time in to underwrite 10 deals a week, you know, because we hate doing it. And so we just realized it's not a good partnership, you know what I mean? And you peacefully part ways. So I think it's really important to find complementary partners, and it's just a combination of having work ethic, skill sets, and other factors. So you just kind of have to kind of try out new people as you go along.
So so Kathy had a question, and then Matthew had a similar question. So Kathy's first question is, did you have passive investors in your first few deals? And then Matthew's is, what advice do you have for new syndicators for moving into larger assets and basically raising capital?
Yeah, great question. So the very first deal we did actually was not a syndication. It was what's called a tenant in common, or a TIC. Okay. And so in a tenant in common, you do not have any passive investors. Every single investor has to be an active member of the deal. And we didn't necessarily have that in mind when we were going into the deal. So basically it was just Robert and I at the time. And we've been underwriting deals for months, and finally this one penciled. And so we said, screw it, let's put in an offer. And we were terrified to put the offer in, but we put the offer in, and then it got accepted. And we're like, oh crap, like what do we do now? And we realized we all of a sudden had to come up with like 1.4 million of equity. And so we kind of were just all in to make it happen. What I did, like 162, 165K left, because I had joined a mentorship program. I was living off savings. I was renovating my house, which was stupid. Don't do that if you don't have a job. I put 160K into the first deal. So I was almost all in. Robert put almost 300K, and we needed to come up with a significant amount. And so we had another partner that we had met, Elisa, and she had just sold a 12-unit deal in Seattle, Washington, and she was looking for a 1031 exchange. And so she called me one day and she said, hey, Zach, I heard you have this deal under contract. I'm looking for a replacement property for my 1031. Why don't I 1031 exchange into your deal and we can do a tenant in common, a TIC? And I was like, that sounds great. Like, what the hell is a TIC? Like, I had no idea what that was, but she had over 600K of equity that she could bring from that. And we had talked before, I got along well. So anyways, with the tenant in common, let's just say for example purposes, let's just say Hayden, Dustin, and I want to do a deal together with our own cash. Okay, let's just say for simple purposes, we need 300K of equity and each one of us has 100K. We can do a tenant in common or a TIC deal. And each one of the three of us is going to represent a separate TIC LLC. So each one of us is a tenant in common. We'll hold it in an LLC for asset protection purposes. Well, the interesting thing about that is that we all are legally active members. There's no passive investors, and we legally have to have a unanimous vote. Okay, so let's just say I have like $100 and Hayden has like 290K in it, and you own like 95% of the deal, Hayden. Well, it doesn't matter. We're still have to be a unanimous vote. The three of us as tenants in common. Okay, so in that deal, we did that TIC where we brought in these three different LLCs, where I had an LLC, I was the manager, Robert had one, and then Elisa did a 1031 exchange. Well, the interesting thing is it was a Freddie Mac loan, and the requirements are that each TIC LLC has to be a manager-managed LLC. So I was the manager of mine, Robert was the manager of his, Lisa was the manager of hers, but you can bring in members into each LLC. So Hayden and Dustin could each bring in other members into their LLC. However, they have to still be active. They cannot be passive investors. They have to have an active role. So I think for us, it was not our initial plan, but when we had the 1031 equity from Elisa coming in, we were talking to our transactional attorney, and we put together what's called a TIC agreement, which is compliant with Freddie Mac, and we learned all the rules of this. And so we had a small group of us who ended up coming in. And I had met Bikram shortly before that. And so he had come in with cash into my TIC LLC. So long story short, the first deal was not a syndication. It was not passive investors. It was a tenant in common deal. And if you have people who are going to bring in 1031 exchange money, it can be a good way to make it happen. However, you need to be very careful because it's a lot different than a syndication in the sense that everybody is active. And so everybody has to have an active role, and you really need to trust your partners, or at least all have the same goal. Because if one of the three of us, Hayden, Dustin, and myself, if one of us said, I don't want to sell, but the other two do, we can't sell. You know what I mean? And so you have to make sure you trust the people that you're with. One cool advantage of the TIC, and then I'll get to the next question, is that you can all three can separately 1031 exchange out of the deal into three separate assets. Okay, so let's just say we all had 100K each, right? Well, let's just say Hayden and I, we got along really well. Dustin wants to go do his own thing, or Dustin didn't like us, whatever, right? So let's say we're going to sell it. Dustin can 1031 exchange. Let's just say we doubled our money. So his 100K is now 200K. Well, he can take his 200K and go buy his own asset from a 1031 exchange. And Hayden and I, we each have 200K now because we doubled our money. So we have 400K total. We can each 1031 into the same deal and take 400K into a new asset. So that's kind of the cool thing about the tenant and common structures. It gives you more flexibility to 1031 exchange in, 1031 exchange out. But you need to make sure everybody is active. You need to document that, and everybody has to have an active role, be on property management, phone calls, et cetera, et cetera. So that's the TIC deal, the first deal we had. And I think the second question was, how do you get passive investors, or how do you gain interest? Is that what it was, Dustin?
Right. Yeah. Pretty much. Yep.
Yeah. So, I mean, yeah. So this is obviously it's very challenging and you have to be very careful because obviously there's SEC laws in play here. Okay. And so, I mean, typically, and I'm not an SEC attorney, full disclosure, right? So I'm going to tell you what we've heard from our SEC attorneys and you can consult an SEC attorney. But basically, the two most common exemptions that are used are 506B as in boy and a 506C as in cat. Okay, so when you're basically have passive investors who are investing in a deal and they have no active role, then legally you're selling a security unless you get an exemption under Regulation D. Okay, and so there's these two most common exemptions, and I don't have a lot of education on other exemptions because this is all we've done. But I think the most common one is the 506B as in boy, which means that you can have up to 35 non-accredited investors in your deal. So they have to be what's called sophisticated, meaning they understand real estate. They're not completely new, but they don't have to be accredited. For those of you who don't understand, accredited basically means if you're not married, that you've made $200,000 or more each of the last 2 years, and you reasonably expect to make that much this year. Or if you're married, you've made $300K as a couple the last 2 years, and you reasonably expect to make that much this year. Or you have a net worth of 1 million or more, not including your primary residence. So with the 506B, the biggest thing to know, you have to have a pre-existing relationship, a pre-existing substantial relationship with every investor prior to them investing in your deal. Okay. And so this is something you have to really be careful of because you as a sponsor are responsible to document that you have a substantive relationship with these investors. And so like when you ask, how do you get investors? I mean, initially, if you're trying to get started, a lot of it is going to be friends and family, people who you know and who trust you, that you have a strong work ethic and that they know that you've really put in the work to try to learn this. And I think it also is beneficial to partner with people who have experience and who have done this before, right? So, I mean, I think that goes really far, is if you can get a co-sponsor who's done syndications before and who has their own investor database and is playing an active role, then that's very important. But that brings up another point, is that you legally, every sponsor has to have an active role. You can't bring people in just to raise money. So you need to be really careful with that. So everybody who's going to be a sponsor on the deal needs to be involved with due diligence, asset management, underwriting, at least be involved and have an active role. So I mean, my biggest advice is go to the people who are friends and family who trust you and believe in you. And then as you're meeting new people, you cannot be selling them any deal you currently have, but you can have a conversation about what you're doing and start to form that relationship and determine if they're sophisticated or accredited. Okay, so that's the 506B. And I mean, I don't know, I think there's other questions, so I don't want to keep going on, but I can get into the 506C later if anybody has a question about that, because we've done one of those too.
Awesome. Yeah, Steve had a good follow-up question about the ticks, actually. He asked, are all participants exposed to risk on a recourse loan?
Good question. So our deal was a non-recourse loan, but our understanding is, and I don't know the exact answer, so I may be incorrect. Okay, so you want to consult your attorney, honestly. But my understanding is you're going to have less risk if you don't sign on the loan. Okay, in the matter of that deal, all three of the TIC managers, so there was 3 tenant in common LLCs. So in our example, it'd be Hayden, Dustin, and I. Let's just say we were the same people in our first deal. The 3 of us all signed on the loan, so we were guarantors on the loan, but it was a non-recourse loan. Okay, meaning that if things fail, the property failed, they cannot come after our personal assets. If it's a recourse loan, as Steve was asking, then yeah, you're personally guaranteeing that. However, my understanding is, let's just say Hayden's the manager of his LLC. He signs on the loan as a guarantor, and it's a full recourse loan. And he has members who are in his tenant in common LLC. My understanding is they would not have the same exposure or liability for their personal assets as Hayden, because they did not sign the loan. But again, I don't want to give you the wrong answer, so definitely consult your attorney on that one.
And I wanted to hop in on Steve's question too. So it's a recourse loan, it depends on what bank you go to and all that. I'm not 100% sure because I've never done, everything I've done's been non-recourse. but they may require everybody in the TIC to sign on it, or or maybe they only require the majority. So there's yeah. So I don't know. That's something, if you wanted to talk offline, we could find the answer though.
Yeah, and on the Freddie, we had a Freddie Mac small balance loan. It was non-recourse. It was like 3 years of interest only, and it was a 10-year term. Interest rate. They did not require all the people in the deal to sign a loan. There was a few of us who signed a loan. There were others who did not sign a loan.
Then let's see. Justin had the question of what class of multifamily do you typically focus on, and then what have you had the most success with?
Yeah, good question. Sorry, I didn't really go into that too much. So yeah, so I mean, our whole business model, like a lot of people in multifamily, I think it's the most common really, is value add. So what that means is that we're looking for older assets that are in upcoming areas. Okay, so we're looking for C class and B class assets that are in C plus to A minus areas, usually C, B, or A areas. And obviously, everything is subjective, right? It's not like there's a big sign that says this is an A property in A area. So you have to kind of know, and it's generally agreed upon. But our business model is to find these older assets where we can go in there. And in Phoenix is an extremely hot market. I think the cap rates in Phoenix are much more compressed than even in like the DFW area where you guys are, Dustin and Hayden. And so for us to make a deal work, we need a value add component, meaning we can go in there and we can do, our business model is light value add, meaning we'll do exterior paint, repair, like recoat roofs, we'll maybe add some amenities, and we'll do light interior renovations, meaning we'll do new vinyl flooring, resurface countertops, paint cabinets, new appliances, maybe add washers and dryers if we can, because that's the best value add component you can really do. So that basically we're renovating the asset to increase the rent, which then in turn increases the valuation. And that's where that margin comes as profit for your investors. Okay. So in Phoenix, for our model to work, we not only need that, we need a value add component. So we need there to be what's called meat on the bone, meaning that there's something we can renovate or some value add component, but we also need there to be some sort of loss to lease in play. And what that means is that the rents on the property are not all the way up to market. Okay. And so it's basically meaning that we could go in day one, and when these leases expire, we can start to increase those rents immediately without doing anything. That's what we've seen deals need to have, those two components. And in Phoenix, the rent growth has been so strong. Just in the last 2 years, it's been over 8% year over year. So if you have not been staying up to it and increasing your rents the last 2 years, you could very well be at least 16% below market in Phoenix. And so that's what we've done, is we found these deals, and they're obviously not easy to find, but we go in there where we can go in and we burn off loss to lease, meaning we'll push the rents up to market value once the leases expire. So we get that bump, and then we'll renovate them and push it up even more. And obviously you do I personally secret shop all the comps. Okay. So I drive to every property that's a comparable property, and I go in there and I get, what are their finishes? What are their rents? What's their square footage? What amenities do they have, to see where we can conservatively push our rents. If we renovate X finishes to this level, can we achieve the rents that this guy across the street is getting? Okay. So you want to be conservative with your loss to lease and your value add projections, but that's our business model, is we're finding. And the thing about multifamily, especially syndication, like these large deals, I listen to a lot of podcasts and education programs sell you on passive income and freedom and all that stuff. And to be honest with you, I think it's mostly BS, because I don't think most of these deals are long-term holds. You know what I mean? Especially a syndication where you have 30 to 100 people. Like we have 100 people in one of our deals, over 100. We have 60 something, 64 in another one. And the reality is that these are basically larger flips. Okay. We underwrite them for a 5-year horizon, and we're assuming there's going to be a recession in that. Okay. So we're assuming like a 3% annualized stable rent growth in a market where it's been over 6% the last 10 years. And it didn't even drop below 2.5% a year during the recession. And inflation's about 2%. Okay. So anyways, we're underwriting for a 5-year horizon, where we're going to go in there, renovate, push the rents, and then we'll sell to get the investors a return. But if we can realize that return in 18 or 24 months, or we can realize part of that return but at a higher velocity, we're going to unload the asset and sell it, because the chances of having all your investors on the same page of wanting to hold it for passive income for 5 years is very small. And you want to return their capital so that they're happy with you. The other risk is that, let's just say after 2 or 3 years, it's going really well, and you're like, I'm going to hold this thing for 3 more years. Well, something like COVID-19 could hit, right? You get caught in a recession all of a sudden, and then it's not performing very well. And you could have unloaded it earlier and gotten them a good return, but now you're stuck with it and nobody wants to buy it. You know what I mean? If you go into a recession. So the way I view, this is my personal opinion, these things are like hot potatoes, right? Because you never know where the market's going to go. And that's our model. We go in there, renovate, increase the rents, increase the valuation, and then exit to get the return, the capital back to the investors.
Awesome. Thank you.
Yeah, of course. Good question.
Caleb had a good question. He asked, can you explain the pay structure for your first syndication deals? Did you charge an acquisition fee? I'd be curious how that differed from the TIC to your first syndication.
Yeah, good question. And so, again, I'll note this again. I'm not an SEC attorney, so consult your SEC attorney. And everybody on any type of syndication deal has to play an active role. Okay, you cannot bring people in and compensate them just to raise capital. The way we structured our first syndication deal, it was a straight 80-20 split, meaning 80% of the deal goes to the passive investors, 20% of the deal goes to us, the general partners, as sweat equity. And because it was our first syndication, we didn't want to take an acquisition fee because we kind of wanted to prove our concept and show that we could do it. And so, I mean, we all had a significant amount of our own money in the deal. So we had significant skin in the game, at least 25 to 50K each invested into the deal of our own capital. We did not take an acquisition fee. And I mean, industry standard from what I'm seeing, and this is my own perception of industry standard, but this is what I'm seeing is most of them seem to be 70-30 splits with an 8% preferred return to the passive investor, and then the sponsor will take an acquisition fee. On our first deal, we just did a straight 80-20 split, no preferred return, and no acquisition fee, so that we felt that our interests were truly aligned with the investors. Because we, as the general partners, like I had 100K of earnest money, so if we didn't close in the deal, I'm out 100K. You know what I mean? My partners also had 50 to 100K each, so we're taking all the risk on the front end by putting up our earnest money. We're also fronting all the legal costs for the SEC attorney, the transactional attorney. There's third-party lending reports that we have to front, like the appraisal, the engineering report, phase 1, et cetera, et cetera. So basically how it worked on that first syndication is we front our own money, we get the deal under contract, we raise capital from our investor base, and then we close on the deal, and we took no acquisition fee. So we as GPs were not compensated upon the close. 6 months after closing, and typically that's the expectation we give is 3 to 6 months, usually 6 months, is when we'll tell investors the expectation is 6 months after closing, we'll start quarterly cash flow distributions. And that's because that gives us 6 months to start renovating and stabilize the asset. And so as GPs in that first deal, we received no compensation until the passive investor started to receive compensation, which was 6 months afterwards, and we started doing quarterly distributions. And so if you're a GP, you're getting carved out some of sweat equity, right? So you own a percentage. So let's just say it's Hayden, Dustin, and I. Well, we'll split that 20% accordingly, and we're going to get cash flow distributions based off of that. And whatever we invested, if we personally invested 50K to the deal as skin in the game, well, that goes on the LP side. That goes into the 80% side. So when it's time to do distributions, we get paid off the 20 side and the GP side and the LP side. Okay. And we also didn't take an asset management fee on that first syndication deal. Again, just because we wanted to kind of prove our concept. We've done other deals, like most recently, we just closed on a deal last month where we went with a more traditional model where we did a 70-30 split with an 8% preferred return to the passive investors, and we took an acquisition fee on the front end. And so basically, for those of you who don't understand, a preferred return means that the passive investors are going to receive a guaranteed 8% cash flow return on their investment before the sponsors receive any distributions. Okay, and I think a lot of investors get confused on what that means, because the reality is most of these deals are not cash flowing 8% year one, year two, even year three or year four. You know what I mean? So what it means is we're going to start doing distributions, and we're not taking any cash flow distributions as sponsors. And then the reality is preferred return structure, GPs will really receive no cash flow distributions throughout the whole of the asset. We're only going to get paid on the front end with the acquisition fee, which is usually a percentage of the purchase price. And then you get paid on the back end when the asset sells. So when the asset sells, we have to pay an average of 8% return per year. So if we held it for 3 years, we have to pay them 8% for year one, year two, year three to the passive investor, plus their equity ownership in the deal, their upside, so to speak. Okay, and then we also took a 2% asset management fee, which is 2% of the monthly collections. Okay, and so it's kind of funny because I've heard investors both arguments. I've heard some people say, starting out, you should not take an asset management fee or an acquisition fee. I'm sorry, because you haven't proven yourself, and you need to prove the model and prove your track record, which I support. I believe that, and we did that. I've also heard people say, I'm not going to invest, and these are experienced high net worth people, so I'm not going to invest with a sponsor who doesn't take an acquisition fee and who doesn't take an asset management fee, because I don't feel like they're incentivized or compensated well enough to be motivated to do a good job with the deal. You know what I mean? So it goes both ways, and some investors will not invest in a deal that doesn't have a preferred return, and some investors don't care. And so you really have to just kind of gauge your investor base on what their expectation is for returns. And everything is obviously negotiable. But I mean, that's kind of what we see as far as like industry standard.
So Steve had a question as far as leverage you're targeting these days, and I'll take just a quick shot at that. But leverage is going to be, at least in the interim, is going to be coming down, with reserves and things like that the lenders are requiring. So, you're, instead of, 75, 80%, maybe you're going to start seeing more, 75, 70, maybe 65. So, I think you're going to start, seeing your leverage kind of come down. And then there's some people that, in a tighter market like this, and especially if they're able to bring more capital to the table, they're maybe going to just, have a lower leverage loan just for, just for shielding the deal for, if we have a, further tumble. So right. I don't know if there's anything you want to add, Zach.
Yeah, no, I agree. I mean, I agree with you, Justin. I mean, even pre-COVID-19, when the last couple of years, Phoenix has been number one in the whole country for rent growth and number one for population growth. And it's been second to job growth behind Dallas. We've still been getting 70 to 75%. If we could get 75%, it's rare, 75% leverage, because the thing is, I mean, these Freddie Mac loans they're debt service constrained. And so they have what's called a debt service coverage ratio, or a DSCR, which is basically saying the property needs to produce X amount of dollars above what your monthly mortgage is, what your monthly debt service is. And so, I mean, Phoenix is considered a standard market for Freddie Mac. So it's a 1.25 debt service coverage ratio. And so because you're constrained to that, it was tough for us to ever get 75%. We had a couple of deals where we did get 75% leverage, and they've been great deals. But I mean, even pre-COVID, we had some 68 to 70% leverage, just because the prices are so inflated and cap rates are compressed. Now, I won't be surprised. And when I say now, I mean, it's also new, right? We don't know if the market will soften or what. But I wouldn't be surprised if you're at 60 to 65%, 60 to 70% leverage. And what that does is it makes it harder to get the returns that investors have been accustomed to getting. Right? Because it just dilutes the returns. Because for every loan dollar you get, you have to get a return. So it just makes it difficult. But I think leverage will continue to reduce for now. we haven't even been looking at deals the last 6 to 8 weeks. We were actually awarded a 90 unit deal 2 months ago now, and we were in access agreement, and we liked the deal, but then COVID-19 hit, and our loan was so uncertain, they couldn't even tell us from day to day what our proceeds were going to be. They cut us like 4 times over a 2 week span, and they kept cutting our loan so much that now we're like, the deal doesn't even pencil. So fortunately, we were not under contract yet. We were going through like an access agreement inspection, and we were not non-refundable on our. I just told the broker, man, this is crazy. Like, first of all, we don't know if our loan will even come through to what this guy is saying. Second of all, we don't even know if our investors are going to want to invest now. So we had to back out, and we haven't even really underwritten deals the last 6 to 8 weeks because the lending environment is so uncertain. So I don't really know what it's going to look like.
Yeah, it's interesting. We were going through sounds like the exact same situation actually over here too. So we definitely dodged a bullet there. But Kathy has a question, how do you stress test while you're underwriting a property in this era right now?
Yeah, I mean, good question. So the biggest metrics you're looking at when you want to stress test a property or you want to have conservative assumptions is you want to have a healthy delta between your entry cap rate and your exit cap rate. Okay, so basically a cap rate, for those of you who don't know, is a fraction. So basically it's your net operating income. So how much money is the property producing on an annual basis divided by the purchase price. Okay, so how much money is it spitting out divided by what you pay for it. As a buyer, you want to have a higher cap rate because that means you're getting a better deal and you're getting a better return on your money. As a seller, you want a lower cap rate, okay, because that means you're getting a better deal. And so when you're going in to buy an asset, you want to assume that the cap rate is going to increase from what you bought it at, okay, because that's a more conservative approach. You're assuming that the economy and the market is going to decline compared to where you're currently at. I mean, across the nation, you're looking at least 1.5% to 2% annual increase in inflation, like the last 10 to 15 year cycle. And so when you're doing this, we always have at least 100 basis points of cushion between our entry cap and our exit cap on a 5-year horizon. Okay. A lot of guys, I see a lot of guys that are doing like 10 to 15 basis points a year, which 50 to 75 basis points. And it really just depends on the area. Like if you're in a worse area, you want to have a bigger expansion on your cap rate because you're assuming that when it's time to sell in year 3, 4, or 5, you're going to be selling in a less favorable market than is currently the case. And if not, then great, that's all upside. But you want your deal to pencil, assuming you're selling it in a less favorable environment. So that's the biggest thing, is having cushion between your entry and your exit cap. Annual rent growth is a big thing too. So like I was saying, I mean, in the 10-year cycle, Phoenix has been like over 6% year over year, just keeps going up. The rent growth in the last 2 years has been 8% plus year over year. But we're assuming stabilized rent growth, meaning we've gone in year 1 and we started renovating and we've pushed our rents that stabilized. So organic rent growth, years 2, 3, 4, 5, 6, we're assuming 3% rent growth, in a market that's much higher than that. It's significantly higher than that. And we've been underwriting in year 1, 4% rent growth because it's been 8% the last 2 years. So this deal that we just closed on about a month ago, we initially were underwriting year 1 rent growth of 4% because it was over 8% the last 2 years in this micro submarket. And once COVID-19 hit, we immediately cut that down in our projections to 2%. We're assuming now 2% year 1 rent growth, and which also increased our economic vacancy. So basically you have your physical vacancy, which is how many units are vacant, right? You have 100 units and 5 are vacant, you have 5% vacancy. Economic vacancy is your physical vacancy plus loss to lease, bad debt, people who aren't paying. Okay, so we increase our economic vacancy by assuming we're going to have issues with collections, we're going to have bad debt, things like that. And fortunately for us, we had a floating interest rate, and our interest rate when we closed was 100 basis points lower, a little over 100 basis points lower than what we were initially modeling. Okay, so we were modeling like a 4.23 interest rate, which obviously these all affect your cash on cash or your cash flow projections, right? So you also want to add contingency on your interest rate, because our lender quoted us a 3.9 interest rate going in. We always add 30 basis points of cushion onto that in case while you're under contract, things fluctuate and your interest rate's higher. Well, fortunately, it came in at like 3.2. And so that actually helped to offset the reduced rent growth that we were modeling, growth in half from 4% to 2%. But the lower interest rate offset that. So I mean, the biggest thing to answer the questions is you want cap rate expansion, you want to have conservative annual rent growth, you want to have conservative economic vacancy, because in the first couple of years when you're renovating, you can't increase the rents all at once. Like the leases are going to be expiring on a staggered schedule, right? And you have to wait till the lease expires to get the tenant out and to renovate the unit, and then it may sit for a few weeks until you lease it up. So you have to assume economic vacancy to compensate for all that.
Okay, but this is Kathy Leiby here. My question about the vacancy in this COVID era, I mean, I've heard some sponsor groups are underwriting like a 30% vacancy. I mean, is that crazy or unnecessary, or is that the reality?
Yeah, no. Go ahead, Dustin. You go ahead.
I was going to say, I mean, it all depends on the property, all depends on the submarket. I mean, there's a lot of variables in there. Are you talking about new deals to purchase, or are you talking about existing deals, or?
Well, just deals that have come that I'm looking at, you know, it's like I don't know how to underwrite anymore in this environment. I don't know what's conservative enough.
Yeah, so I was just on a webinar with, it represented, there were 3 or 4 guys on there. The guy, you know, they ranged in number of units between 30,000 units and about 1,500 units. They were all over Texas, DFW, Houston, and Austin, and they don't know how to underwrite either. So it's really difficult. You know, we're talking with you know, management companies as well. We're like, hey, how should we underwrite? You know, the one guy suggested on the line or on the webinar an hour or two ago, you know, that has 30,000 units. He's been doing this for 30, 40 years. And he's like, I don't know if do I underwrite no rental growth, you know, or no income growth for year 1, or is it do I also do it for year 2? Like no one knows what it's going to look like, and no one knows if, you know, hopefully it's not the case, but does this thing spike back up during flu season? You know, do we go back to shelter in place? So there's a lot of unknowns, and you know, and that's why the lenders have the reserves on. And, you know, something Hayden and I have talked a lot about, even if those reserves go away, you know, I think it's prudent to potentially think about, you know, whether the lender does away with those reserves or not. We may want to have those reserves, period. We may want to, you know, build, you know, more reserves in than we certainly have in the past, because you know, not to be, you know, I'm a half glass full guy, but, you know, hopefully this doesn't happen again, but, you know, we'd like to be prepared if it does.
Yeah, I mean, that's a good point, Dustin. And to further answer your question, Kathy, I mean, on, like, for example, on this deal, one of our deals that we acquired, we just did a webinar last week for our investors, and we stress tested the next 90 days, and we did assume 30% economic vacancy in May, and then we actually made it more. I'm trying to remember, it was over 30% in June, and then it was between 25 to 30. We're somewhere there in July. So, and in April, we as of Monday, we had 97% collections on that asset. So we actually, it did really well. And I think, it's hard to say. To your point, Dustin, nobody really knows, but I think what you need to look at is you need to look at your reserves. How long can you survive assuming you receive no income. So on the deal we just closed, we modeled it last week. Basically, we could survive assuming we received 0% collections. All the tenants, all 112 tenants, don't pay their rent for 6 consecutive months. We will still be able to pay the debt service and the operating expenses of the property, purely living off of like operational contingency that we've underwritten in, plus our CapEx renovation dollars. So that's like worst case scenario. We're saying, okay, for 6 months on that deal, to go. On another deal, the first one, we raised a lot of money for renovations, and then our PM came in, and actually they cut down the budget of what they were charging. So we actually had a surplus of renovation dollars. I mean, on that one, we can last 3+ years off just of reserves. And so that's why it comes down to your financing strategy too. I think some of the guys that are doing more of these aggressive bridge loans where they've been at 80% loan to cost and all their renovation dollars are financed, they're not going to have as big of reserves because their renovation dollars, they didn't raise them. They're all being loaned to them by the lender. And if they didn't have a lot of operational contingency, then they could be in trouble if their collections start to take a hit. So, I mean, it's a good question. I think the biggest thing to ask sponsors, or if you're looking at deals, is let's assume 50% collections or 0% collections for X amount of months. How long can you pay the debt service and the operating expenses over that amount of time to survive?
Yeah, all that is makes great sense. The problem I'm running across is when I underwrite like that conservatively, and so then the purchase price, comes down,
Yeah.
and the seller is like, there's no way. So, I have to move on. So the sellers are, still looking back at what their properties are worth, and I have to look forward to see at what that property is worth. So there's a disconnect.
Yeah.
So
No,
I can't find a deal.
Yeah. Right now it's tough. I mean, I don't know what your thoughts are, Dustin, Hayden, but I think that we haven't seen the effects yet of COVID-19. And I'm not saying we may or may not see detrimental effects, but at this point, the market has not softened enough to like shift back into a buyer's market.
The only softening we've seen is if the deal's in trouble, and they were in trouble before COVID-19 hit. And so we've kind of, we've been looking at a few deals, and then, or if their loan's up, or if they're having partnership issues or something like that. But those are mainly the deals that we're looking at where there may be a potential decrease in price. But the webinar I was on an hour or two ago, they were saying they were predicting a 5 to 10% decrease in prices. Obviously if a guy was going to sell it for, if he was going to sell it for 10 million, a few weeks ago, it's not like he's going to instantly say, oh yeah, I'll take $1 million haircut. No problem. Unless they're in trouble or something like that, they're probably going to hold on to that. They're going to kind of see what the market looks like. And then, if Fannie Freddie take away, if it's a new loan and it's not an assumption, and someone has to get a new loan, they may wait for Fannie Freddie to see if they ease up on those reserves, because that's going to help out pricing for that seller. They did mention that they thought there was going to be about a 15% discount on Houston assets, because they're getting the double whammy of COVID-19 plus oil's been down to -37 or whatever it was. So but the people that were on the line that were huge buyers or just huge owners, a lot of them are kind of I don't say sitting on the fence, but they're being very cautious. The only people that are actively buying within that group of 50,000 units, one guy was buying 3 deals in Houston. 2 of them he had under contract before COVID-19 hit, and then one of them he's getting a 25% discount. So he's like, I'm buying a 2017 asset, and I'm getting a heck of a deal, so I'm gonna move on this.
And Yufan, he's got a question about how is the new near to zero Fed rate will impact the multifamily business. I think it's just going to keep cap rates pretty compressed. Everything I've heard is that they'll probably expand a little bit through this time, but with interest rates being so low, it'll probably keep cap rates pretty low too. I don't know if you've seen anything different in the Phoenix market, Zach.
Yeah, honestly, we haven't, because we haven't even really gotten a term sheet. Like in the last 6 to 8 weeks, we haven't been underwriting new deals since we backed out of that last deal. So I can't say. I mean, in theory, lower interest rates would give you a higher cash on cash or cash flow return for the passive investor. But yeah, there's other effects too, like you said. So honestly, I don't know, because we just haven't been modeling deals recently.
Well, and Fannie, I don't know about Freddie, but Fannie's been putting floors on their interest rates, and so even though the Fed rate that you had spoken to, and I'm not a lender, but I'd heard that Fannie put a floor in, so even though the Fed rate had dropped, it doesn't necessarily mean that Fannie had dropped their rates. So
right, you're right. Yeah, there's not a direct correlation.
So I guess that's it on the questions. Yeah, Steve, you're right. I don't know. I've never been much of a stock market person. I just don't understand it. But so I've been more a real estate guy. So that's where I'm putting more of my money. But yeah, any other questions for Zach, or anything you want to end with, Zach?
No, I just want to say thank you, Hayden and Dustin, for having me on your webinar, and thank everybody for joining. Great questions. I'm always happy to help people out. I mean, I know how it is to try to get in the game and not really have any lifeline or anything. So I think if people are trying to get into it, you just have to keep grinding and be patient. And I mean, watch webinars like this, and feel free to reach out to me if you guys ever want to set up a call. I'm happy to help however I can.
Awesome. Yeah, really appreciate your time, man. You awesome, knocked it out of the park. So appreciate your time, Zach.
Thanks so much, Justin. Thanks, Hayden. Thank you, everybody, for joining. Really appreciate it.
All right. See you guys. See you, everyone.
Thank you.
Take care.